The easy way to predict markets and generate safe income. Number one, track if the Fed is buying or selling treasuries. Right now, they are currently buying. Number two, track if the Fed is raising or lowering interest rates. And at this current time, they are lowering interest rates. Number three is keep an eye on inflation. Is it moving up or down, and at which speed? Currently, based on their official reports, it is below expectations. What's our strategy for this environment? Low rates, low inflation, plus QE. I'm expecting this period will last from 2019 till maybe 2021. And in our portfolio, we have a 52% equity position, a 38% bond position, and 12% gold. This puts us trading the SPY ETF on Monday, Wednesday, Friday, taking advantage of all option expirations for safety and income. Emerging markets on Tuesday with a smaller position. The bonds with the TLT traded on Thursday, again, selling covered calls for income. And then a buy and hold position in GDX. That's the gold miners, not spot gold, but the mining companies. This portfolio is extremely close to this fellow right here, Stanley Druckenmiller, who has averaged 30% a year for several decades. What comes next? Well, if you listen to Ray Dalio, like I do, rising inflation, rising rates, all alongside quantitative easing is probably in the books until at least 2022, maybe longer. This is likely to cause the bond market to pop first, unlike other times in history. So this would leave us long equities with 30% of our portfolio, and we're going to be headed towards nose-bleeding prices in stocks. Bonds, a large position, but we use option callers to make money from bonds slowly going down in value. We'll talk about how to do that in a future bootcamp module. And then this is when you want to load up even heavier into gold and silver. So you can see we still trade the SPY with a positive Monday, Wednesday, Friday. Jump into silver on Tuesday, and again, that's with a put option below and selling a covered call above. Safer way to play these weekly trade alerts for income. And then on Thursday, we're going to be doing the negative caller trade on the TLT. So we'll make money as the TLT gradually drops in value. And at this point, we're still long gold. What comes after that? High interest rates and no quantitative easing. Do you like Jeffrey Gundlach? That's one of my other heroes I study intently. This position would be 48% equities, 37% bonds. And this will be when you can actually make a lot of money just putting old-fashioned dollars in the bank. Go back to the inflation of the 70s, and that's the period of time where they had to hike up interest rates, and most likely what will be happening from 2022 through 2027. It will be dealing with some severe inflation that will force the central banks to stop quantitative easing and raise rates. So at this point, we'll have jumped out of gold. We'll be shorting the stock market, buying inverse hedges like SQQQ, and back to being long bonds and the dollar. So this allocation is something I think we'll be seeing very popular, while most buy and hold investors are clueless. They'll be losing on most of their assets. After we've jacked up rates much higher, we'll have a period of dropping rates and expected QE. Think of the Alan Greenspan era. This could last for decades after a nice reset. This is where your Warren Buffett strategy does very well. And I would upgrade my SPY position to the QQQ. Still long emerging markets, jump from the TLT to investment grade bond ETF LQD. And in our buy and hold strategy, we'd be buying up shares of Apple. Now this is at current prices. These ratios will change as the prices of the assets change over time. Let's take a look at some of these different stocks and ETFs and how they correlate with one another. So in this chart, we can look at a pretty scaled out view of the S&P 500 against the TLT. Now the TLT are your 20, 30-year treasuries, and so we're really playing interest rate change. What's important to see from this graph is, in general, you want to be long equities. That's quite clear. But there are periods of time where you do not want to be long equities, and we'll be reviewing those periods of time in a few future slides in this presentation. But if we just look back at the last several decades, we can see the orange line spikes up when equities spike down. And that's important. That's why we have this overlap of stocks and bonds that are nearly equally weighted. So that when one goes down, the other can buffer the other part of your portfolio. Here's a look at the TLT. And again, you can see in general it has been going up in value, but the big spikes line up precisely where stocks sell off rapidly. And in fact, if we zoom in on a few periods, you can look at 2008. Stock market was rallying up 40% only to crash. And so in the orange line below, you can see the 2008 crisis and the stock market crash, while bonds went up in value dramatically, 40%, offsetting those losses. If we go to this period, we're looking at 2010 through 2012, and you can just see the crisscross. When one goes up, the other goes down, and vice versa, but in tandem, they both went up together. And in this period of time, from 2013 through 2015, we can see the stock market went up 51%, and our bonds didn't do anything bad, just down 2.8%, but they were standing by to rescue your portfolio if there was some sort of stock crisis. Fast forward through 2016 through 2018, we can see the same setup. We've got stocks rocketing up at the start of 2016, and our bonds take a little bit of a sell-off from 17% up earlier during this period to down to 0%, but that's offset by a 33% gain in your equities. And if we look at another period, most recent, we can go back to that 2019 Christmas scare, or rather 2018 Christmas scare right here in the middle of the screen, where your TLT jumps up and helps offset a lot of these costs. And now in 2019, we've seen both the stock market and the bond market rally up together. Emerging market ETF represents a basket of 1,000 companies, so twice as many companies as the SPY ETF, that serve 4.2 billion people in Asia. A lot of this does go to China, so that is a little bit controversial, but a lot of it also goes to South Korea, Japan, and all the surrounding countries in that area. So it has rapid growth, much faster than the United States, and has great long-term potential when we're in the right market cycle. Now, there are some catches to that. When the U.S. is trying to bully China, clearly that's a good time to use our option callers on those Tuesday trades on emerging markets to bet down. But in general, without the friction, they are growing at a much faster rate and have a much larger population to serve products to. Now, in terms of adding gold to our portfolio, typically we want to buy gold when we have quantitative easing, lowering rates, and then the potential for fear in the market. And on the other side, when we don't have all three of those, look out below. These prices in gold can fluctuate very quickly to the downside. And also keep in mind that gold and the TLT do have some correlation, but oftentimes they do break away. And the more uncorrelated our assets are, the harder it is for us to have a losing period of time. And we can see up top here, gold had a huge rally after quantitative easing started in 2009, but it was quick to sell off after the quantitative easing began to slow down by 2012. Now, when gold prices are at elevated levels, it makes sense to buy the miners. That's what Stanley Druckenmiller is already doing, And again, our GDX position has the same big position that he has in his portfolio. And if this ETF were to go back towards the 2011-12 highs, it has at least 100% gain from here. So what's in the SPY ETF? It's a $262 billion fund. It's growing rapidly. It's heavily weighted in technology, financials, healthcare. Some of the big names that represent the biggest positions are Microsoft, Apple, Amazon, Facebook, Berkshire Hathaway, Google, JP Morgan, Johnson & Johnson. These companies have huge revenues, $39 billion, $55 billion, $12 billion. And so this is not to try to analyze this in great detail, but just to feel the sheer size that these companies represent in terms of annual revenues and net income. It's just tremendous. And these are big names, but they're only 1% of this index. Intel, AT&T, Home Depot, Visa. And as we go down the list, the position sizes get smaller and smaller. So if you see a name on here that you have in your portfolio now, but your position size is significantly larger than 0.5%, you're probably way too invested in that. Take Netflix, for example. Popular stock. A lot of people have huge positions in it, but in the SPY, it's only 0.5%. Qualcomm, 0.38%. CVS, 0.33%. Goldman Sachs, only 20.26%. Emerging Markets ETF has $25 billion in assets, 1,059 holdings. Some of its larger positions are in technology, financials primarily, and in Hong Kong, which is just an outlet to China, Korea, Taiwan, Brazil, South Africa, Russia, Thailand, and Saudi Arabia. Biggest companies held are Alibaba, Tencent, Taiwan, Semiconductor, Samsung, China Construction. And again, these companies are also pulling huge amounts of revenue with net incomes in the billions of dollars. So it makes sense to have some exposure to these emerging markets when there's not times of conflict between the US and China, or at least when there's periods of peace. And here's some of the smaller positions in emerging markets ETF. Vail, many of you have probably heard of. Samsung Electronics. JD.com. It's just a very diversified product that makes your life much easier. Another ETF we're going to cover in this video is GLD, which is this iShares Gold Trust. It does track the price of gold. And this is what we like to invest in when we believe there will be quantitative easing in the near future, and we're going into a period of lowering interest rates. After it's official, there is QE, I like to jump into the miners, which is GDX, and where we're currently at as of recording this video. And a lot of the mining is happening in Canada. Here's a breakdown of your countries, and here's the big gold miners. Now, if you have a large position in a gold mining company, and it's not on the screen right now, you're probably investing in the wrong gold company. These are really the big players who have access to the capital to start mining gold and selling it while there's time. There's not going to be a whole lot of time where gold is going to be at high demand, and that comes to an end once inflation gets in here and they start hiking interest rates. And so you can see many of these gold companies actually have losses. They're not making money over the last several quarters. So you want to be careful who you invest with. It could be very dangerous to go into some of these smaller companies. And in fact, one of the YouTube channels I love to listen to, you have to get to the 5th page. Let me get back to it. And this guy's been touting Sandstorm Gold. It's only 0.5% in GDX, so be careful buying small cap gold companies. And eventually we'd want to rotate from the SLV, the silver trust ETF into SIL, the silver miners, which has a slightly different group of companies who specialize in mining silver. So we can see those two different types of funds. And in the silver miners, here's your best companies to have positions in. But this is going to be after we see another breakout in gold and a breakout in silver spot price before I'd recommend jumping into this. And again, these companies are also losing money over the last several years, and you want to focus on the ones who have access to capital so they can actually mine some silver and gold and sell it while they have time and before it's too late. So when does the long bond stock strategy break down? In general, when there's rising interest rates, the end of quantitative easing or even quantitative tightening, or inflation or deflation. And so we can see some major problems in the markets during certain periods of time. In the World War I, World War II period, we had inflation and deflation. Now, interesting enough, leading into the Cold War, inflation was stable, and we had a huge market rally from really from 46 all the way up to 65. But after that, we had runaway inflation, and we had to have a Federal Reserve that jacked interest rates all the way up to 20% at some point until Alan Greenspan came in. And from there, they were able to lower interest rates back down, and we had this huge rally in the markets from the 80s through the 2000s. So that gives us back to the current time frame where we're in a low interest environment with lowering interest rates and quantitative easing. So what's this inflation all about? Well, here's your current CPI index, but it's changing and definitely manipulated to serve number one, trying to make sure the government gets its debt filled, and then number two, taking care of the banks who are best buddies with the government. Here's a look at interest rates and inflation over this period of time, and you can see we're clearly in a downtrend right now and most likely headed towards 0% rates once again until inflation comes back. Now, if we do look at this chart, we can see some of the major moves in inflation. It can be pretty idle for quite some time and then just spike up, and that's where we get these calamities and economic crises. What's the general strategy of the central bank? Well, they try to keep the interest rates a little bit above the inflation rate. And so as the inflation rate spikes, they will aggressively increase interest rates. So you can see with the red line, every time the blue line got close to the red line, they jack it up pretty quickly to fight off inflation. Now, over time, it does seem that the markets are getting more and more sensitive to interest rate hikes, as we saw in 2018 when they tried to raise rates and quantitative tightening at the same time, and 98% of all assets crashed. And every time they do this tightening, we can see these little red dips in real gross domestic product show up, and that's typically when we get our big stock crashes. Also, in terms of playing the bond market, they are highly tied, almost magnetized towards that federal fund rate. So we can see all these different treasury maturity rates and how they all seem to just follow the effective federal funds rate. Now, the scary part of all this is there's clearly inflation, and they are adjusting that calculation to suit their own needs. And so if we do look at some of the statistics, we can see there's massive inflation, especially in things the government's had its hands on, like medical care, housing, and college education. So whenever they are willing to subsidize or protect the banks, those businesses tend to come in and jack up rates because they know they won't ever lose. There's that college tuition inflation since the government began guaranteeing college loans to banks and also making it something you cannot file bankruptcy for. Here's the cumulative effect of CPI increasing at just 1 to 2% a year over the course of time. It's a dramatic effect. And if we actually look at some of the older CPIs, we would already be at much higher inflation rates than they claim, and thus way higher federal funds rate would be demanded. And if you go back to 1980, it's in a clear uptrend and near 10%. So obviously they are not trying to create an economic crisis by reporting the true inflation right now. Now, the other part of this is we have a red-hot economy, which is going to slowly but surely put pressure on wages and drive prices up. So let's take a look at some of these periods and look at what happened to the federal funds rate and the stock market during that time, as well as inflation and deflation. Okay, World War I, 1914 through 1918, and you can see we had a lot of inflation during the war. After the war was over, we had massive deflation, and after that we went into the roaring 20s where we had a great stock market. Now this was all coming to an end after all the reparations on Germany could not be fulfilled, and it spread to a global depression where we had, again, deflation and the Great Depression from 1929 through 1939. A decade. This is what Ray Dalio is out there predicting is coming our way in the near future. And I think my timeline and estimates of those different scenarios in the first few screens do mimic pretty closely what he's predicting. So we can look at this chart and see the relatively poor performance of the stock market from 1915 through 1920. We got out of the war and started a massive stock market rally from 1,000 to 5,500. Everything was groovy. America got rich from World War II, had all the gold. Everyone else was really suffering. And eventually the problems from Europe spread all the way to the US, and we entered this depression. After that, we started quantitative easing massively and entered into a Cold War period. So that's from 1947 through 1991. And this, again, is something very similar to what we're facing against China right now with a new Cold War. Now, if we look at the inflation, it was relatively under control. There's just a few spots where it really spikes. But you can see from 1945 all the way to really 1967, inflation stays steady between 1 and 3%. After that, you can look in the 70s, and it goes from 2% all the way up to 10%, which is something that is completely out of control and created the longest bear market in U.S. stock history. So we can see from 1965 through 1980, we have this huge long-term stock market crash. Now there's bounces up that are significant, and you'll see in the next slide, the interest rates were going up and then down and then up and then down. He couldn't tell if he had killed the inflation or not, apparently. But from the earlier period where we did have inflation under control, we can see a long-term bull market. So Paul Volcker was the Fed from this period, and you can see he was slowly but surely jacking rates up, pulling it back down, jacking rates higher, and then pulling it back down, then jacking it up even higher and pulling it back down, all the way up to 20% now. I highly doubt we'll get anywhere near those levels in our lifetime, but I do think it needs to jump in the 5 to 10% range in the next decade to weed out all the malinvestment, the $288 trillion of debt circling the globe. Now, what happens after that period? We have inflation under control. It's dropping and staying in this range from about 2 to 3%. What happens during that period? A massive stock market rally from 1982 through 2000. There's a few blips, but in general, nothing could put a dent on the stock market. And what do we have? Alan Greenspan dropping rates slowly but surely until we ran into the dot-com bubble. Now, this had the first blips of inflation at 3.4 in the dot-com bubble and 3.8 in the '08 housing bubble. But other than that, interest rates were, or rather inflation rates were relatively under control, and we've had relatively good periods of time in the stock market. Especially after the 2008 episode where we did record levels of quantitative easing and also a period of lowering interest rates. Now you can see every time we tried to raise interest rates to fight off inflation, we got ourselves a nice stock market crash. They tried to do that in 2016 through 2018, and we ended up with a crash in the end of 2018 only to see them start lowering rates, and now we're at a period of quantitative easing and we have no inflation concerns yet. Now I say yet because quite clearly the world keeps us up, keeps printing as money escapes out of these financial markets where it's all been circulating. It's going to make its way into the economy and put pressure on prices. So now we've got Jerome Powell, and again, he is in a period of lowering interest rates and doing massive quantitative easing, although they're trying to say it's not QE. Now, normally we do this after a market crash. This time around, they're doing it at all-time highs. And so I would say the only thing to get in the way of the stock market, at least for short periods of time, will be hiccups in the trade war, number one, and then most likely number two, eventually inflation. But we may be a ways off before that starts to pick up. So that's a wrap on Module 1 for our bootcamp program. In the next module, we'll be learning how to do all of the trades, including covered calls and buying put options to really maximize our strategy and target that 1% return per month with very little drawdown. Thank you.